Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at two under-the-radar growth stocks to consider buying before their upcoming earnings results. And those two stocks are New Holdings and WIX. But before we get everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into New Holdings and WIX, which are the two growth stocks to consider buying before their upcoming earnings results, I quickly just want to go over where the market stands as we've kind of chopped around over the last several weeks in most of the start of 2025. So the S&P 500 dipped midweek and the NASDAQ closed barely higher after the quote, after somewhat hot, like that was all the headlines, hot inflation data on Wednesday. The bulls then stepped in pretty quickly, though, after stocks opened lower solidly on Wednesday, as I said, to kind of just close roughly flat midweek. I'm recording this Thursday midday, and as I'm recording this, the NASDAQ's up about 0.9%. It's almost 1% higher, and the S&P 500 was up solidly as well. So this kind of shows that the market shook off that quote hot inflation data because the headline figures didn't really tell the whole story, and Wall Street already knew that the last mile of inflation would be the hardest. Plus, Jay Powell and the Fed were already committed to slower rate cuts, so a slightly hotter inflation report isn't going to make it so that they don't cut rates several months from now and then in the back end of 2025. And it's worth noting that the market has continued to chop around and hold that 50-day moving average for both the NASDAQ and the S&P 500 to start 2025, despite the DeepSeek news, the earnings, all the earnings reports, jobs data, inflation, tariffs going back and forth. They've all kind of been blips on the radar at this point. So we're wondering what's going to move the stock market next in any meaningful way. And it could be that Wall Street is really waiting for the AI stock, which is Nvidia, to report its Q4 results and offer 2025 guidance before it makes its next big move. The company reports in the last week of February. Nvidia has been range bound for roughly 8 months at this point. It fell midweek after getting rejected at its 50-day, but I record this on Thursday afternoon. The stock was up about 3%, jumping right back above that 50-day. And it's worth noting that the big reason why it's possible that the market is waiting for Nvidia is that obviously the DeepSeek news threw a big kind of wrench into the broader AI spending. So if Nvidia reports light guidance, you could see a rather substantial pullback. And it's worth noting, so based on some earnings data that Zacks has, if we're looking at the semiconductor industry earnings, it just shows how big of an influence Nvidia has. So if we're looking for 2024, we're calling for about $108 billion in total earnings for all of the semiconductor industry. But if you do that without Nvidia, it's at about 40 billion. So chopping over $60 billion, nearly $70 billion off of that. And if we look ahead to 2025 and 2026, we're calling for $150 billion in earnings in 2025 for the semiconductor industry and $180 billion in 2026. But those jump down to just $51 billion in 2025 and $62 billion in 2026 if you take out Nvidia. So that's the reason why so much of the market could be possibly hinging on what Nvidia says at the end of February in terms of what it's looking for and for its growth going forward. So the market's been content to chop around. It's held its ground at the 50-day. Nvidia could be kind of the next big mover, either up or down for the market to start 2025. So with this backdrop, though, we're going to take a look at New Holdings, which trades the ticker NU, ahead of its Q4 results that are due out on Thursday, February 20th. New is a somewhat under-the-radar stock, trading for around actually less than $15 a share at the moment, even though it's soared about 170% in the last 2 years. New is a digital financial services powerhouse with a platform that currently reaches roughly 110 million customers across Brazil. That's most of the market, though it's expanding into Mexico and Colombia as well, which will, could be kind of the new growth areas as well. But its core market is Brazil at the moment, though it is expanding in Mexico and Colombia. The Fintech company is in the midst of shaking up the banking and financial services sector in large economies with huge populations that offer big long-term upside. It kind of burst into the Fintech space in these countries by attempting to cut some of the burdensome red tape of more traditional banks. Its core products are credit cards and then digital banking and fintech accounts. It also offers personal loans and insurance. It boasts that it's the largest digital banking platform outside of Asia and the fourth largest financial institution in Latin America by number of customers. Roughly 1 in every 2 Brazilian adults is a customer, which is pretty impressive. So this backdrop alone is kind of a big reason that Warren Buffett's Berkshire Hathaway owns new stocks. So it's always good to have Buffett at your side. He must see long-term upside for the company to be invested in this stock. It grew its customer base by 23% year over year in Q3 to 110 million. Its monthly average revenue per active customer hit about $11, with more mature cohorts up to $25. So overall, though, that figure was up 25% year over year, which is great to see. And its monthly activity rate had another sequential increase up to 84%, up from 83% in the year ago period as well. This represents the 12th consecutive increase in activity rate, underscoring its ability to consistently provide compelling value for its customers. And its monthly average cost per active user also remained below $1. It was at 70 cents, which is a great sign that it has to be able to keep its cost down, which we'll get to in a bit. But I want to just quickly, before we move on, just showcase how big the Brazilian and Mexican economy are for the possibility of big growth going forward. So Brazil's population, and then we'll touch on the economy. So Brazil is currently the 7th largest country in the world in terms of population, roughly 212 million people. And Mexico is the 11th with around 131 million people. So that just gives a size of how much upside there is. In terms of economic firepower, Brazil is the 11th largest economy in the world, and Mexico is the 14th. So big expansion possibilities there in these large growing economies in Latin America. News Q3 revenue overall jumped 56% on an FX neutral basis to a new record of 2.9 billion. And if we look ahead, we're calling for 47% revenue growth in 2024 to go from 8 billion to nearly 12 billion, and then another 35% revenue growth next year to get all the way up to 16 billion. So roughly doubling its revenue between 2023 and 2025. And then on the bottom line, we're calling for 75% adjusted earnings growth in 2024, and then another 39% adjusted earnings growth next year. And its revenue growth would come on top of 68% growth in 2023. So really big, massive expansion for new. In 2022, it pulled in just 4.8 billion in total revenue, and it's going to get up to 16 billion in 2025. So a massive growth for new over the last several years. Just shows its long-term upside. In terms of its recent earnings revisions, they've stagnated over the last several months, though they're down slightly for 2025 from 62 cents 90 days ago to 58 cents at the moment, though its most accurate estimate is coming in at 60 cents. So relative stagnation on the earnings front, which is not a bad sign since it's topped our estimates by 20% the last 2 quarters, which is a good sign. So overall, that stagnation has new at a Zacks rank number 3 hold. And if we look since the company went public in late 2021, the stock's up around 14% because it went public kind of just at a bad time, near the top of kind of the growth rally for a lot of these COVID stocks when interest rates were low. So it went public at a bad time, tanked for roughly 6+ months, and now it's been on a big ride ever since then. So it's up 107% in the last 2 years to blow away the finance sector, which is up just 36%, and tech, which is up 75%. But it's only up about 30% in the last 12 months, so it's slowed down recently. And some of that's to do with its tumble from its mid-November or after its mid-November earnings release following its somewhat disappointing guidance. Wall Street was clearly hoping they would continue to boost their outlook for both revenue and earnings. They did not, so the stock's been hit. New is currently trading at, as I record this, at $13.60 per share. So big upside, as I said, 15% upside from its current highs or its all-time highs, and 14% upside from its average Zacks price target. In terms of its technical levels, it's back above its 200-day and 50-day moving averages after it found support at its some of its 52-week lows, which is sort of near its some of its early levels from when it went public that are kind of, if you're a technical trader, you could look at the chart. I don't need to describe it too much, but it found lots of support at its 52-week lows, and now it's back above both its 50-day and 200-day moving averages. It did go from heavily oversold RSI levels back to above overbought. So we could see a little bit of a pullback in the near term, depending on if it offers disappointing guidance once again. But long term, the upside is there. And if we look at in terms of valuation, it's trading at 22.1 times forward 12-month earnings, which marks a solid discount to tech, which is trading at roughly 27 times forward earnings, and it's trading at a 98% discount to its own high. So its valuation levels have really improved as its earnings outlook grows. And if we look at its PEG ratio, which factors in that longer term earnings growth outlook, it's at 0.46 versus tech's 1.76. So massive discount here. If you're looking at long-term growth, new is definitely one to put on your radar. So it might be worth taking a flyer on this cheap growth fintech stock operating in key markets. And we should remember that it's trading for $115 a share, and Warren Buffett's Berkshire Hathaway owns it in its portfolio. And now we're going to move on to WIX.com, which trades on the ticker WIX, so WIX. The company is set to announce its fourth quarter 2024 results on Wednesday, February 19th. WIX is bolstering its website building offerings to help it carve out more market share among professional site designers. And it's posted blowout earnings results over the last several years as it continues to up its earnings guidance, which is a great sign. WIX started really by helping small businesses and really anyone else who needed to design and maintain a website all the way back in 2006. The company offers an extremely intuitive and user-friendly tools to help customers build essentially DIY, so do-it-yourself style websites through an array of offerings. The company over the last handful of years, though, has raced to introduce far more features to help it attract professional website builders. For instance, in early 2020, it launched Editor X, which was a platform made specifically for designers and agencies, so not just sort of small businesses and one-off people who want to have their own website, but actual companies building via Wix is a growth area they see. So since then, it's rolled out various AI-based offerings. So that's a lot of the growth recently is AI-heavy site generation and various things to help these large companies and regular users build and maintain their website. It also has partnerships with the likes of Meta and Google and many others. So overall, all of these efforts to expand its offerings beyond just kind of the do-it-yourselfer and roll out these AI-boosted offerings have helped it expand beyond that DIY and kind of re-energize its growth and, more importantly, boost its profitability, which we'll get to in a bit. So the company did really big revenue growth in 2017, 2018. It was doing about 45% growth in 2017 and 2018, 26% growth in 2020 or 2019, 30% growth in 2020, another 30% growth in 2021, but then that slowed substantially in 2022 to 9%, and then it did 13% growth last year, even though the stock has jumped higher. So that's showing that a lot of this is based on its ability to continue to grow revenue at a solid low double-digit clip, but also to jump from a huge loss to now profitability. So it reported its first GAAP profitability profitability year in 2023. So it did 55 cents per share in 2023 versus a loss of $7.35 in 2022. So massive growth on the bottom line, and it's going to continue going forward is what everyone seems to be expecting. So that's a good sign for WIX. WIX also achieved the rule of 40 in 2024, a full year ahead of its plan. So the idea here is kind of a big thing across SaaS companies, so software as a service and software companies in general, is that WIX combined revenue growth rate and profit margin should exceed 40%. So it did that in 2024, as I said, a full year ahead of schedule. WIX profitability efforts were spurred by activist investor Starboard, which also pushed Salesforce and others to change course amid rising interest rate environment where growth at all costs was no longer valued. So that's what's happened over the last several years. So looking ahead, we're calling for roughly 13% revenue growth again in 2024 to go from about $1.6 $6 billion to about $1.8 billion, and then another 14% growth next year to get above $2 billion. And then on the bottom line, we're calling for 39% adjusted earnings growth and then 20% growth next year for WIX. And its earnings revisions have really gone straight up since the start of 2022. So they've just gone straight up, though they've stagnated a bit recently for 2026. Its overall earnings revision positivity helps it land a Zacks rank number 2 buy at the moment. And its outlook for 2025 has actually climbed a little bit recently, so that's a positive sign. Now we're going to look at the stock performance. WIX stock is up 80% in the last 12 months to blow away tech, which is up around 25%. This is part of a roughly 1,000% run in the last 10 years to blow away tech, which is up around 315%, yet it's still trading 35% below its 2021 highs, so there's still some long-term upside potential there. The stock is finding some support here after breaking out significantly. It looked like it was going to possibly have a pullback, but it looks like it's finding some support at some breakout levels from back in 2020. So this could be kind of a line that the bulls need to hold here in the near term. If you want to look at a technical chart, if you're listening to this, it did have also the bullish golden cross with the 50-week moving average crossing above the 200-week moving average in the fourth quarter of 2024. So that's a positive sign. And if we look at a shorter dated chart, we can see that it's currently chopping around its 50-day moving average at the moment, heading in to its earnings release and trading at roughly neutral RSI levels. That said, its valuation is certainly holding the stock back. It's trading at 60 times forward 12-month earnings versus tech's 26 times. Though if we look at its PEG ratio, which factors in that longer-term earnings growth outlook, it's better compared to tech. It's at 2.5 compared to tech's 1.8. So that shows that its earnings growth is going to continue to rise. It also has to improve its balance sheet. It currently has slightly more liabilities than assets, which is not a great sign for any company, especially a tech company. But then again, WIX appears to be taking a ton of the necessary steps to help run a profitable, growth-focused business for years to come. So overall, Wall Street's relatively high in the stock. 16 of the 22 brokerage recommendations Zacks has are coming in at strong buys, and it might be time to possibly look at WIX heading into its earnings results as it focuses on AI efforts and expanding its growth to larger businesses who want websites. And obviously some valuation concerns there, but it's still trading 35% below its all-time highs, even though the market and lots of other tech stocks have made new highs throughout the last year plus. So it's certainly worth considering WIX heading into its upcoming earnings release. And that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.